Let's break down what today's market action means for your money. Here is what it actually means for you. Here's the thing nobody tells beginners. When the market drops like today, your first instinct is to check your balance and panic. But panic is the expensive emotion. What matters right now is understanding what actually happened and what it means for the money you're trying to grow. I'm going to break down the 3 things you need to know so you can make a real decision instead of a fear decision. The market moved because rates just became real competition for stocks. When the Fed says rates are staying sticky, investors go, okay, I can park my money in a 5-year treasury and get 5-point-something% guaranteed. That changes the math on why you'd own a growth stock that might double in 3 years versus something safe that pays you now. So you saw rotation out of tech and into treasuries. That is not a crash. That is mechanical rebalancing. But it feels bad in your portfolio because we've been trained to chase returns, not manage risk. Here is where the pain lands. If your portfolio is 70% stocks and you're in tech, this day costs you real money. Not hypothetical. Your balance sheet is smaller. Retirees who need income get a different kind of hurt because their dividend stocks are down, but treasuries now pay better. So they're stuck yesterday's safe income. Play is today's overpriced legacy. Young people with bonds got a gift, but most young people own 0 bonds, so they feel nothing but the pain of their growth stocks dropping. The real test is whether you actually know what you own. Here is the flip side, nobody highlights. Someone made money today. The person who had dry powder cash sitting there waiting just got a gift. You can buy Microsoft at a better price. You can fill your long-term position in the companies you actually believe in. The people who suffer most are the people holding during the drop and not buying during it. History doesn't reward panic. It rewards the people who show up with conviction on days like today. Here is your action list. First, open the actual statements. Don't look at the percent change. Look at whether your allocation drifted. If you were supposed to be 60 stocks, 40 bonds, and now you're 65 stocks, 35 bonds, rebalance back. That is mechanical. Second, if you've been waiting for a better entry in a stock you believe in, a stock you did research on, not a hot tip fill part of your position today. Not all of it, not full size, a third of what you want to own. Third, don't sell anything out of fear today. Most people's worst trades come after close, when they've stewed on the day. Sleep on it. Here is what historically happens next. If this is just the market repricing rates, you get a few weeks of chop. Up 2 days, down 1 day, boring grind sideways. If earnings disappoint in July, we get a real pullback. The bet you're making by holding or buying today is that the companies are worth what they'll earn in 6 months, not what the market feels like paying right now. That bet either works or it doesn't. But the frame isn't days or weeks. It is quarters. So your real test comes in 3 weeks when the companies that matter report numbers. Until then, do not overthink it. You got this. That is the read. Keep it simple, react to the data, and join the free Discord at Discord. GGRsh47, RZGM.